Today I want to talk a little bit about trends in value investing. You may know that there's a range of approaches to value investing. Perhaps the best illustration of that is Warren Buffett, who started off using the traditional Benjamin Graham approach of finding very inexpensive assets or cash flow streams, what has often been called cigar butt investing, to the approach that he uses today, which is to try and buy great companies that have what are called economic moats around them, meaning that they are not susceptible to competition and have high returns on capital, and very much good companies bought at reasonable prices. And I think that in the world of value investing today, that approach of buying great companies with moats has become very popular, and that in fact some of the success of that approach in the last number of years is actually more a result of a momentum factor. In other words, more and more money being oriented in that direction, and as a result of that, the success is created by the momentum of investors headed in that direction. But in fact, if you look at various studies, the approach that produces the very best investment returns is actually the approach that Warren Buffett came from, which is the purchase of very inexpensive assets or cash flow streams. And the reason that that approach succeeds is because of a thing called reversion to the mean, meaning things in the past that were not so good are likely to get less bad or better, and as a result will create an investment return. So I believe that the strategy of finding very inexpensive securities, classic deep value investing, is likely to be the more successful strategy, not only on a historic context, but also on a go-forward basis. And I think that it is very difficult to actually find great companies at reasonable prices, and those companies that have a sustainable competitive advantage. As an example, a lot is made of Buffett's investment in insurance, and he, of course, is interested in insurance for the investable float that an insurance business creates. But consider in the insurance investment or industry in a different context, you're asked to sell your product at a price, the premium, before you even know what your costs are, future claims. That to me doesn't sound like a great business model. So, there are lots of different views about what a great business is, and I think it's very difficult to find a business where you can determine that its greatness, its moat, is sustainable. And I think a lot of money has been lost in businesses that appeared to have a moat, but that moat is erased by competition, by a ever-changing world. So for us at TAKOTA, our focus is on finding very undervalued securities, and it does not mean that we would not buy a great company at a great price, and does not mean that we would sell a great company simply because it became fairly priced if we believed that on a go-forward basis, that moat, the thing that created the greatness of that business, were to be sustainable. We would sell it when those future cash flow streams have been discounted back to the present in the share price. So a little bit on trends in value investing.